It's Thursday afternoon, everybody, which means it's time for Townhall Takeaways. Willie Delwich here. Glad you're listening this afternoon. We've got a lot to talk about. The message is the search for bull market behavior and kind of identifying what it looks like and then seeing whether or not there's evidence of it. We can start just from a price perspective. S&P 500, for example, looking at what it's done over the past 2 years and ask the question: is that bull market behavior? Well, the first part of that time period into 2021 rallied 20 some odd percent from where we began the year. Yeah, that looked like bull market behavior. After that, from the peak down to the trough, it was about a 30% 25% or so peak to trough decline. Not so much like bull market behavior. But now as we've gone since off of those October lows, we've made a higher low, made a high, then a lower high, lower low, we made a high, then a higher low and a higher high. And yeah, we're kind of finishing where we began 2 years ago, but we're starting to see evidence of bull market like behavior from a price perspective. If we could hold above those December lows and then get back above those February highs, that would be more bull market behavior. So we're kind of heading in the right direction, but there's work to be done for the S&P 500. If we zoom out and look at not just that price index, large cap US stocks, but look more broadly at what we would think of as being indicators of bull market behavior and look at our bull market behavior checklist, it's a little bit uncertain at this point. Yes, we've started to see a net new high advanced decline line. So looking at daily new highs versus new lows on the NYSE plus NASDAQ start to rise, start to expand. That definitely is bull market behavior. But last week we saw more new lows and new highs on a weekly basis. That's not bull market behavior. It was 1 week after 7 weeks in a row of more new highs, new lows. So we're not going to draw too many firm conclusions at this point from that single data point. But at the same time, bull markets tend to see more new highs than new lows. So we want to see that get back to that situation. From a global perspective, we want to see the percentage of global markets above their 50-day averages at least above 40, probably actually about above 70. Coming into this week, we're at 38. Ticked a little bit higher so far this week, but still not at 70%. And that's not bull market behavior. Long-term trends for the ACWI, for the value line geometric index. So global indexes, not the S&P 500, but global indexes, or global index, and then the kind of a median equal weighted US index. Those trends falling 55 weeks in a row for both of those. That's not bull market behavior. And then look at the S&P 500, lots of focus on where it is relative to its 200-day average. That doesn't excite me as much as the direction of the 200-day average. If that's rising, then yeah, that's bull market behavior. That's where all of the net gains over the past 30 some odd years have come. We're not getting that. 207 days in a row of the 200-day average falling. That's not bull market behavior. Our search for bull market behavior pretty narrow at this point in terms of the evidence we're finding to support a bull market case. Suggests to me that there's more work to be done for stocks to prove the bull market case. So that's the bull market behavior. We also want to focus on what's happening from an intermarket relationship, and some important takeaways from kind of what the last decade has taught us. And here we're looking at stocks versus commodities. And interesting that as we talk about this, we're just now seeing the switch from a long-term trend perspective towards stocks having the upper hand after 107 weeks in a row of commodities having an upper hand. Then that's 107 weeks in a row of commodity leadership. That's the longest sustained trend since the 1970s, and follows after 8 years where it was pure stocks all the time. 90% of the time period from 2012 to 2020 through 2020, stocks were in an uptrend relative to commodities. During that time period, commodities kind of got forgotten about. And the call to action here is to keep them part of the conversation. Remember commodities, even if we're not allocating to them. And the lesson here is pretty straightforward. We can see what commodity or stocks have done over the past 50 years. We can see what commodities have done over the past 50 years. If we stay in harmony with the relative trend between the two, leaning towards stocks when they're in a relative uptrend, leaning towards commodities when they are in a relative uptrend, and switch back and forth, we get better returns and less volatility. We don't always need to have commodity exposure, but we always want to have commodities part of the conversation as we're thinking about allocating our portfolios, as we're looking at bull market behavior, not just in stocks, but sometimes in commodities, sometimes in bonds as well. So those are the takeaways. Looking for bull market behavior after 2 years of sideways in the S&P 500, not finding a lot of it, but we also want to keep track of longer term opportunities in terms of switching between stocks and commodities, and keep commodities part of the ongoing conversation, even when they aren't part of our actual portfolios. Those are the takeaways. I'm Willie Delwich. Do this every Thursday afternoon. Glad you tuned in. Hope you do again next week. Have a great week, everybody.